Hello everyone, John AG here. Welcome back to my channel, Aurex. If you haven't yet, subscribe to my channel. In this channel, you will find the real information, real market updates that everyone cannot tells you. So please subscribe this channel and love you all of my subscribers for your support. And please watch this video till the very end because YouTube will not push my videos to more people. Imagine for a moment that you wake up tomorrow morning, step out of your front door, and discover that the fundamental laws of gravity have been quietly altered while you were sleeping. The ground beneath your feet feels unstable. Objects do not fall the way they used to, and every structural engineer on the planet is frantically trying to recalculate the math that keeps our skyscrapers from collapsing. This terrifying sense of foundational instability is exactly what is happening to the global financial system right now, in the year 2026. We are not just experiencing a market correction. We are not just navigating a routine cyclical recession. We are living through the catastrophic failure of the modern financial architecture, a systemic rewiring of the very concept of value, and the greatest transfer of wealth in recorded human history. You are on the front lines of an economic war, and the ammunition is not bullets or missiles. It is currency, commodities, and the absolute truth of physical assets. To understand the magnitude of the financial hurricane we are currently navigating, you must first understand the true underlying nature of wealth. Wealth is not a digital digit flashing in green on your smartphone banking application. Wealth is not a piece of paper adorned with the faces of dead politicians. Wealth is, at its absolute core, stored human energy. It is the crystallization of your precious, finite time on this earth. When you set your alarm clock for dawn, when you endure the agonizing commute, when you pour your intellect, your sweat, and your physiological stress into your profession, you are engaging in a sacred social contract. You are trading the most unrecoverable asset in the universe, your time, for a medium of exchange. You do this with the inherent trust that this medium will faithfully store your energy, preserving your labor across space and time, so that months or years later, you can unleash that stored energy to feed your children, to secure shelter, to provide medical care, and to build a generational fortress around the people you love. Over the last several decades, and culminating in the absolute carnage we have witnessed leading into 2026, the central banking apparatus of the world has ruthlessly violated that sacred social contract. We have watched in slow motion horror as the purchasing power of our fiat currencies has been incinerated by the invisible, regressive tax of inflation. The rampant, unchecked printing of unbacked currency units, the explosion of global sovereign debt to levels that transcend mathematical comprehension, and the weaponization of the dollar-centric financial system have left the global working class and the middle class financially paralyzed. You are running on an accelerating treadmill just to avoid falling backward into poverty. Your grocery bills have doubled, your energy costs are suffocating, and the dream of owning debt-free property has been stolen from an entire generation. This profound, visceral fear of total currency debasement is precisely what drove millions of terrified investors into the ultimate historical safe harbor: gold. And for a significant period of time, gold performed flawlessly. It executed the exact mandate it has held for 5,000 years of human civilization. As the geopolitical chessboard fractured, as wars dragged on, and as central banks quietly hoarded bullion behind closed doors, gold surged. By the beginning of this year, gold utterly shattered historical resistance levels, blasting past the $4,500 an ounce mark and briefly touching an intraday all-time high of over $5,500 per ounce. It was a spectacular, breathtaking, parabolic move. I was sitting in my office late one evening, watching the algorithmic trading screens light up like a fireworks display. The mainstream financial media was in a state of absolute euphoria. Pundits and retail investors alike were celebrating their incredible nominal gains, cheering as their net worth, measured in rapidly depreciating fiat currency, climbed higher and higher. But as a professional quantitative investor, as someone who studies the deep underlying mechanics of global markets, a profound sense of unease began to gnaw at me. I looked at the physical gold I had accumulated over the years. I love gold. I respect gold. It is the Tier 1 reserve asset of the global monetary system, the undisputed sovereign wealth of nations. But in the ruthless, unforgiving arena of financial markets, allowing yourself to become emotionally attached to an asset is a fatal liability. While the herd was blindly piling into gold at $5,500 an ounce, driving the metal to a staggering, extreme premium over its historical moving averages, I detached myself from the emotion and began a rigorous, cold-blooded analysis of the broader precious metals complex. I started looking at the relative value story, the deep historical metrics that the algorithms try to hide from the retail public. And that is when I saw it. It was staring right back at me from the datasets, a gaping historical anomaly so massive, so mathematically absurd, that it demanded immediate, decisive action. That anomaly was the gold-silver ratio. The gold-silver ratio is not a new concept. It is arguably the oldest functioning financial metric in human civilization. During the Roman Empire, the ratio was legally codified at 12 to 1. In the United States, the Coinage Act of 1792 fixed the ratio by law at 15 to 1. Over the last century of the modern industrial era, this ratio has fluctuated but generally found an equilibrium somewhere between 50 and 65. In the simplest terms, the ratio dictates how many ounces of physical silver it requires to purchase 1 single ounce of physical gold. But financial markets are deeply emotional and prone to staggering inefficiencies during times of panic. In late 2025 and early 2026, while gold was dominating the global headlines and soaking up all the institutional safe haven capital, silver was quietly, tragically lagging behind. The ratio had stretched out to a completely irrational level, blowing past 85, then 90, and hovering dangerously close to a ratio of 100 to 1. This is the exact point where human emotion must be completely silenced, and the cold, unfeeling laws of mathematics must take the steering wheel. As an investor who relies heavily on quantitative data, I do not base my decisions solely on nominal price points. I look for statistical arbitrage and the undeniable gravity of mean reversion. The pricing relationship between gold and silver is not random. It can be mathematically modeled as a stochastic spread. Let us define the price of gold at a given time t as PAU, t, and the price of silver as PAG, t. The foundational ratio is simply expressed as GSR sub t equals P sub AU, t, P sub AG, t. To truly analyze the explosive potential of this trade, we must look beyond the simple division and examine the logarithmic spread, defined as S sub t equals natural log of P sub AU, t minus natural log of P sub AG, t. Because both of these precious metals are tethered to the exact same macroeconomic drivers, real interest rates, inflation expectations, fiat currency debasement, and central bank liquidity, their spread possesses a powerful magnetic tendency to revert to a long-term historical mean. We model this relentless mean-reverting behavior using what is known in quantitative finance as an Ornstein-Uhlenbeck process, a sophisticated mathematical framework used to describe the velocity and trajectory of reverting assets. D S sub t equals theta, open parenthesis, nu minus S sub t, close parenthesis, dt plus sigma dw sub t. In this complex but beautiful equation, S sub t represents the current wildly stretched spread. The symbol mu represents the historical, deeply ingrained long-term mean. The variable theta signifies the raw speed and aggression of the mean reversion. And the term sigma dw sub t accounts for the standard Brownian motion, or the erratic, day-to-day volatility of the market. When I ran these calculations on my systems in early 2026, the current spread S sub t was resting multiple standard deviations above the historical mean mu. Let me be incredibly clear about what this means in plain language. The mathematical probability of this ratio violently compressing was not just a theory, it was a statistical near certainty. The elastic band tying gold and silver together had been stretched to the absolute breaking point by institutional panic and retail ignorance. It was preparing to snap back with a kinetic force that would redefine portfolios. If you held gold, you were holding a fantastic asset. But if you held silver, you were holding a coiled spring packed with financial dynamite. Beyond the pure, undeniable gravity of mean reversion, there is another critical mathematical principle that transforms silver into the ultimate, undisputed wealth-building instrument during a precious metals bull market, the concept of beta. In the realm of high-level finance, beta measures the extreme sensitivity and volatility of an asset's returns relative to a benchmark. When we evaluate physical silver purely as a monetary derivative of gold's price action, we can calculate its beta by looking at the covariance of their respective returns. Beta AG equals covariance of RAG, RAU times sigma AU squared. Historically, across multiple decades and multiple market cycles, silver carries a beta ranging from roughly 1.5 to 2.0 relative to gold. This mathematical reality dictates that if gold moves upward by 10%, silver possesses the inherent algorithmic tendency to surge by 15% to 20%. The reason for this explosive upside volatility is market mechanics. The physical silver market is remarkably small compared to the massive, ocean-like liquidity of the gold market. When institutional capital, hedge funds, and panicked retail investors realize they have missed the massive move in gold, they aggressively pivot to the cheaper alternative. Pouring billions of dollars of institutional capital into the tiny silver market is the equivalent of trying to force the water from an industrial fire hose through a residential garden hose. The pressure builds exponentially, the structural integrity of the paper market fails, and the physical price explodes upward. I sat back and looked at the heavy, beautiful yellow bars sitting in my vault. By maintaining my position in gold at a historically anomalous and stretched ratio, I was actively leaving massive, life-changing amounts of leverage and upside potential on the table. I was not optimizing the stored energy of my life's labor. The mathematics were screaming at me to make a move. But quantitative models and historical ratios are only one half of the investment thesis. The other half is anchored in the brutal, inescapable physical reality of the year 2026. Gold is almost exclusively a monetary metal. It sits in deep, subterranean vaults gathering dust, acting as a static, immobile ledger of sovereign wealth. It is beautiful, it is finite, but it is fundamentally inert. Silver, on the other hand, leads a schizophrenic double life. It is deeply ingrained in human history as a monetary metal, but it is simultaneously the single most critical, irreplaceable industrial commodity on the face of the earth. Silver, identified by the atomic number 47, is a chemical miracle. It possesses the absolute highest electrical conductivity, the highest thermal conductivity, and the highest optical reflectivity of any element known to humanity. In our hyper-advanced, technology-driven era, there is no substitute. If you want to build the future, you must consume silver. And I do not mean hoard it, I mean consume it, destroy it, and bury it in landfills where it is economically impossible to recycle. Let us look at the massive, unstoppable industrial juggernauts that are currently devouring the global silver supply. First, the photovoltaic industry. The global, politically mandated transition to green energy has triggered the construction of massive, continent-spanning solar farms. Every single high-efficiency solar panel rolling off the assembly lines requires a highly specialized silver paste to capture and conduct the sun's energy. The gigawatt expansion in 2026 alone has shattered all previous consumption records. Second, the revolution in transportation. The modern electric vehicle is no longer just a car. It is a rolling, high-performance supercomputer. These vehicles require dozens of silver-coated contact points, millions of microscopic silver switches, and miles of highly conductive wiring to manage the massive electrical loads without melting down. But the most terrifying and aggressive demand driver of 2026 is the explosion of artificial intelligence. The AI arms race has birthed hyperscale data centers that consume the electrical equivalent of small sovereign nations. The quantum-level computations occurring inside these facilities generate immense equipment-destroying heat. High-performance AI servers demand bleeding-edge thermal management and flawless electrical conductivity. They require massive quantities of silver in their semiconductors, their cooling matrices, and their power distribution nodes. For nearly a decade leading up to this moment, the physical silver market operated at a structural, fundamental deficit. The world was voraciously consuming hundreds of millions of ounces more than the global mining sector could possibly pull out of the Earth's crust. And here is the terrifying secret about silver mining. You cannot simply flip a switch and mine more of it when the price goes up. Roughly 70% of all silver mined globally is a byproduct of mining for zinc, lead, and copper. If the global economy slows down and the demand for base metals drops, the supply of byproduct silver collapses with it, regardless of how high the silver price climbs. The supply is fundamentally, mathematically inelastic. The only reason the global industrial machine did not grind to a halt years ago was because they were draining the massive, above-ground historical stockpiles to fill the deficit. But by the dawn of 2026, those vaults were running dry. The structural industrial deficit was violently colliding with an explosive, panicked surge in monetary investment demand. Armed with the absolute statistical certainty of mean reversion, the wealth-multiplying leverage of a high beta, and the undeniable physical reality of an apocalyptic industrial supply squeeze, I made the call. I took a massive portion of my physical gold holdings, my ultimate safe haven, and I transported it to my trusted, high-volume bullion dealer. I handed over those small, heavy, incredibly dense yellow bars. They fit easily into a small, inconspicuous bag. In return, I executed the swap. The visual and physical contrast was staggering. In exchange for a small bag of gold, I received an absolute towering mountain of physical silver. It was not something I could carry in a bag. It required heavy-duty monster boxes. When I loaded those dense, tightly packed boxes of pure silver into my vehicle, I could hear the suspension groan under the immense weight. The back of the vehicle physically sagged toward the pavement. There was a profound, deeply resonant psychological emotion tied to holding physical wealth in this manner. When you log into a brokerage account and look at the digits representing your stock portfolio or your fiat currency, you are looking at a fragile counterparty illusion. It is a digital hallucination that can be wiped out in milliseconds by a state-sponsored cyber attack, frozen indefinitely by an emergency government decree, or diluted to absolute zero by a central bank printing press running amok. But physical metal? You feel it in your bones. You feel the immense, undeniable weight of the universe in your bare hands. It requires muscle to move. It requires physical space to store. I was taking my stored energy, my life's labor, and I was trading a fundamentally overvalued asset for a fundamentally undervalued asset, entirely outside the collapsing, debt-riddled fiat currency system. I completely bypassed the dying US dollar. And then the wow moment arrived. In late January 2026, the broader financial markets suddenly woke up to the exact mathematical reality I had modeled. The realization hit the algorithmic trading desks and the hedge funds like a freight train. The gold-silver ratio violently compressed in a matter of days. Silver, which had been languishing in the high 20s and low 30s, suddenly caught fire. It surged past $50 an ounce, rocketing through major psychological resistance levels at $70, blasting past $80, and entering into a historic, breathtaking short squeeze frenzy. For a brief, shining moment, the price touched an unbelievable $120 per ounce. The strategy had worked with absolutely flawless, terrifying precision. The high beta had dramatically amplified the global monetary panic, and the undeniable industrial deficit had provided the rocket fuel for the launch. My portfolio's true purchasing power did not just experience incremental growth, it multiplied exponentially. But anyone who has spent time bleeding in the trenches of the financial markets knows that parabolic, vertical spikes never last forever. The system always fights back to protect itself. Following that massive historic run, we witnessed the brutal, devastating, historic crush of February 2026. As the volatility in the silver market threatened to bankrupt major institutional short sellers, the Chicago Mercantile Exchange, the CME, stepped in to protect their clearinghouses from a systemic, cascading collapse. In a desperate defensive maneuver, they aggressively hiked the margin requirements. They raised the margin on gold from 6% to 8%, but they targeted silver with absolute malice, jacking the margin requirements from 11% to a staggering 15%. This sudden, brutal drain of liquidity forced massive, heavily leveraged paper traders to liquidate their positions in a blind panic. The paper price of silver came crashing back down to earth, settling violently into the mid-70s, right where we currently find ourselves today, in late May. This is the exact moment where the psychological fortitude, the iron discipline, and the emotional resilience of the true investor are ruthlessly tested. It is incredibly easy to feel defeated, to feel a sense of despair when you watch the quoted spot price on your screen correct by 30% or more in a matter of weeks. But you must aggressively separate the illusion of the paper market from the undeniable truth of physical reality. The massive commodities exchanges, like the COMEX, are nothing more than highly leveraged, hypothecated, fractional reserve casinos. For every single ounce of real, physical silver sitting quietly in a registered vault, there are hundreds of digital paper claims being traded back and forth at lightning speed by high-frequency algorithms. When the exchange arbitrarily hikes the margin requirements, it is the paper illusions that crash. But I ask you to look at the physical world around you. Did the hyperscale AI data centers suddenly stop generating heat? Did they stop needing bleeding-edge thermal conductors? Absolutely not. Did the politically mandated global rollout of solar panels suddenly cease, eliminating the need for photovoltaic silver paste? No. Did the crushing, suffocating global debt of the fiat system magically disappear over the weekend? Not a chance. If you held physical silver in your own personal possession during that brutal paper correction, you did not lose a single microscopic atom of true wealth. The sheer weight of the metal in your vault remained exactly the same. You still hold the exact same quantum of stored human energy. The digital spot price flashing on your screen is merely the temporary price at which leveraged paper traders are currently experiencing a liquidity panic. It has absolutely zero bearing on the intrinsic, fundamental, industrial, and monetary value of the physical element in your hands. As we look forward into the dark, uncertain horizon of the second half of 2026, The massive macroeconomic tectonic plates continue to shift in ways that heavily, undeniably favor the continued outperformance of physical silver. We are currently bearing witness to a historic, paradigm-shifting transition of geopolitical power and physical wealth moving rapidly from the West to the East. The BRICS nations, Brazil, Russia, India, China, South Africa, and their newly minted allies, are executing a coordinated, aggressive de-dollarization strategy. They are dumping U.S. treasuries and frantically accumulating tangible, physical commodities. They are building alternative financial settlement systems like Project Enbridge, bypassing the Western SWIFT system entirely. Global central banks, recognizing the extreme fragility and weaponization of the dollar, are hoarding gold at a pace not seen since the Second World War. This relentless, price-agnostic central bank accumulation has placed an unbreakable iron floor beneath the price of gold. And because the laws of physics, mathematics, and market beta dictate that silver is magnetically tethered to gold, that sovereign floor powerfully supports the silver market as well. The smartest, most well-capitalized institutions on Earth are waking up to this reality. Major global research desks are quietly revising their models, noting that due to the inescapable structural deficits, physical silver prices could easily maintain an average baseline of over $80 an ounce for the entirety of 2026, establishing a new, dramatically higher floor. Right now, in this very moment, we are sitting in a quiet consolidation phase. The market is taking a deep breath, digesting the massive, violent moves of January and allowing the long-term moving averages to catch up to the price action. This is not a time for panic, it is not a time for fear, and it is certainly not a time to be shaken out of your position by paper market manipulations. The gold-silver ratio is currently oscillating around the 75 mark. While that is a significant improvement from the terrifying 90-plus levels we witnessed previously, it is still mathematically elevated far above the long-term historical mean of 60. The stochastic spread is still stretched. The mathematical probability still heavily favors silver. The apocalyptic industrial deficit still demands silver. At the absolute core of our existence, true investing is not just about beating the CPI inflation metric or validating a complex mathematical thesis on a spreadsheet. It is about something much deeper. It is about human survival. It is about establishing a perimeter of protection. It is about having the ability to look your spouse, your children, and your grandchildren directly in the eyes and knowing, with absolute certainty, that you have built an impenetrable financial fortress around their future. A fortress that no corrupt politician, no desperate central banker, and no algorithmic flash crash can ever breach or tear down. When you make the conscious, incredibly difficult decision to swap out of overvalued, manipulated, debt-based paper assets and secure radically undervalued, utterly vital physical commodities, you are taking back your sovereign power. You are forcefully removing your stored human labor from a parasitic system designed specifically to extract and dilute it. You are locking your life's energy inside a timeless element that was forged in the unimaginable heat of a dying star, an element that has outlasted every Fiat empire in human history. My decision to change out my overvalued gold for radically undervalued silver was the single most powerful, mathematically sound, and emotionally freeing financial maneuver I have executed in this entire decade. It required stepping far away from the bleeding herd, trusting the deep, unyielding mathematics of mean reversion, and possessing the rare courage to act on physical, undeniable realities rather than carefully constructed paper narratives. If you take anything away from the words I've spoken to you today, let it be this singular truth. You must question the narrative that is fed to you by the system. Do not accept the fragile, crumbling illusion of fiat wealth as reality. Look closely at the raw data. Deeply understand the terrifying industrial deficits. Study the long, brutal history of monetary collapses, and take immediate, proactive steps to secure your personal legacy before the mathematical certainty of mean reversion arrives at the doorstep of the broader global economy. Thank you for your time, your unwavering trust, and your relentless dedication to seeking financial truth in a world of deception. Stay safe, stay incredibly vigilant, and I will see you in the next video.